Okay, let's talk more about Jay Powell and the Fed and what is going on right now in Wyoming. Joining us from Waltham, Mass. is Brad McMillian, Chief Investment Officer at Commonwealth Financial Network. Brad, the released remarks came out from Jay Powell, and he's speaking right now. What do you make of what we're hearing from him today?
I think what he's trying to do is thread the needle here. He wants to certainly not alarm markets, but at the same time, you notice what he's leading with, which is that the economy is doing basically okay. Inflation is moving back towards the target. What he seems to me to be saying is we don't really need a rate cut, but we're very, very aware of the risks, and it'll be there if we need it. Or in other words, we're back to data dependency.
Do you think that'll do the trick? Do you think markets will accept just Powell saying, you know what, we see what you want, but we're not going to give it to you right away?
I think the markets are probably going to react negatively initially, and in fact, we may already be seeing that. We saw markets pull back on the China news. We saw them come back a little bit, and now they seem to be ticking down again. But at the same time, the thing is, markets are looking at the policy, but then they're going to look through that to the economy. And if Powell is saying the economy is okay, and he seems to be, then that should mean that a rate cut isn't necessary. And I think the market will get to that eventually.
Brad, it's Kristen here. So we were actually just talking about those retaliatory tariffs from China. Do you actually think this might spur some of the hawks at the Fed to really take a more dovish tone and approach?
I don't think so, not until the data shows up. Because when you look at the effect on the markets of the tariffs, a lot of the effect has already happened. In other words, when you look at the markets reacting, this has been in the news flow for a long time. This is new, but it's not that new. As someone said earlier, it's out there, it's been talked about, so most of the reaction has already happened. I think the Fed is very clearly split on a lot of things, but I think the hawks are pretty confident that things are okay.
Brad, when you say that Jay Powell just keeps noting, look, the U.S. economy is doing pretty well, and there are certainly a number of factors you can point to, especially we got some positive retail sentiment numbers about 2 weeks ago, even though some of the retail earnings reports were bad. All that being said, the macro and the geopolitical situation continues to develop, and you wonder sort of how long the U.S. can try to plod along on its own. I mean, obviously, we are affected by everything happening, not only with the U.S. and China trade war, but in Europe and in Germany. And I guess I'd ask you kind of how much of that burden should be on the Fed and on Jay Powell to be so reactive to forces outside of the U.S.?
I think that's really the question they're dealing with when they talk about the risks, because the Fed, they don't have a magic wand.
Right.
They're setting interest rates, they're doing monetary policy. There's only so much that can do. So to some extent, they have to be reactive rather than proactive. And the thing about being reactive is you have to have something to react to, which brings us back to the data. When you look at confidence, both consumer and business, when you look at consumer spending, when you look at job growth, yes, there's a lot of risks out there, but the actual facts on the ground aren't nearly as negative as the headlines. I don't think the Fed can react to headlines, and I think they're very clear they're not going to.
Yep. A lot of the sentiment right now and concern is headline driven. All right, Brad McMillian, thanks so much. We'll have to have you back on soon.
Thank you, Dan.